So Gwen, if you want to start the video, then Gwen, I'll probably go through the nothing is intended to be individualized investing advice part again too, once it's started.
Okay. Yeah, you're good.
Great. All right. So now we are recording this meeting of the Austin Women's Investing Group on optimizing your retirement accounts. This is Sara Glakis. I'm just going to repeat what I just said, which is nothing in this meeting, in this group, nothing said by anyone on the call or in the chat is intended to be individualized investing advice. And I know that has never, ever been a problem. But what we are here to do is to share what we know with each other. Everyone is here muddling through the markets as they are, muddling through saving money, investing money, getting more comfortable around money, and that's what this group is for. So please use the chat button to share any questions or comments. And as I go through the slide deck, I'll take a minute every once in a while to see if Gwen wants to share any of your questions with me so that we can answer them in real time. So without further ado, I think we'll go ahead and get started. Just so everyone knows, I think I'm sharing my screen. You should have my slide deck up there that says optimize your retirement accounts. It's kind of red and pink. So hopefully you're all able to see that. All right. Hopefully I'm able to actually move my slides. Can I do that? There we go. All right. Here's a bunch of disclosure language. At the very top, it says nothing in this course is intended to be investing advice. You are responsible for your own investing decisions. I think that goes without saying. Everything in the slide deck is believed to be accurate, but one of the parts of investing that makes it so tricky is that we're using on past information in order to make projections or forecasts about the future. That's just what investing is. You know, I know I've said this in this group a bunch of times, and I'll say it again. One of the things I absolutely love and find fascinating about finance and why I chose it as my profession is that it's forward-looking. So if you think about accounting and finance are related, they're both money topics. Accounting deals with taking these transactions that happened and putting them in categories so that you can see something that happened in the past and you can know what already happened. But finance is about making forecasts and predictions about the future. So that's what makes it fascinating and terrifying and really difficult to navigate because we are trying to do the best we can with the information that we have today and the information we know about the past to make predictions about the future. So this topic, investing, is not supposed to be easy. No one should say it's easy. It's not easy because we are just what we are doing is trying to make predictions about our own lives and what will happen. But then we also have to try to get some idea of what might happen in the stock market or the bond market or the housing market. And all of those things together make this a really tricky, confusing, fascinating, exciting, terrifying topic. So all of this information that's presented here is, again, trying to put into context for everyone what you can be doing in order to do the best you can without ever having perfect information. Do the best you can to make decisions that hopefully will serve you well in the future. So this is just more of that. You guys can read this when we share the slide deck. All right, so I love Warren Buffett. We talk about Warren Buffett a lot in this group. This is one of my favorite all-time quotes of his. Someone's sitting in the shade today because someone planted a tree a long time ago. I mean, that is really the essence of investing. When we talk about investing in this group, we talk about the way I define investing is, you know, you're putting your time, your effort, and your money into something today with the hopes of profits or income or gains in the future. But the time element of being an investor is really important. None of this on this call, on pretty much any call we ever do, has anything to do with getting rich quick. It has nothing to do with it being easy, about there being a secret formula, about knowing some sort of magical way to turn $1 into $10 in the next month or year even. There's this element of time. And so that's what I love about this quote is that, I mean, how long does it take a tree to grow? It takes 10 years, 20 years, 50 years for this to grow. But if you want to have a big tree in the future, someone needs to plant a little tree today. So pretty much every day in investing is starting that process. Some of you might be further along in the process. Maybe you planted your trees 20 years ago, or maybe your parents planted trees 40 years ago that now you are getting to use. But this is all about taking that concept and saying, okay, what can we do today so that we can benefit from these decisions in the future? And we're really talking about like kind of a long way in the future. So keep that in mind. Using retirement accounts. The reason we're doing this topic is because most of your saving and asset growth will probably be done in one or more retirement accounts. Most of us, that's just kind of either where you start, or they're the type of accounts that you tend to inherit from people if you're in that position. So we're going to learn about what the retirement accounts are. One thing I just want to point out here is that the retirement accounts on their own are not your assets. You can think of the retirement account like a tool in your toolbox. Sometimes I like to think about it as the box that you're putting your investments in. So sometimes people will say, well, I have a 401k, but I really want to start investing. If you have a 401k and you have money in your 401k, and the money in your 401k is being invested in a stock fund or a bond fund or something like that, then you are already investing. You are investing inside your retirement accounts. So hopefully that becomes a little bit more clear as we go. And when it comes down to it, it's not the most important thing in this slide deck. It's just know that if you have a 401k through your job and you're putting money into it, you're investing. These retirement accounts are special. So you get valuable tax benefits by putting your investments in a retirement account. The account itself is a tax shelter. So this is why it's a special tool that might be in your toolbox. We all, as long as you're over the age of 18, you have the ability to open a brokerage account, put money in it in your name, and start investing. That's a great way to invest. There are no strings attached to it, but there are some tax ramifications to investing in a brokerage account. And as we go through the slide deck, I'll start pointing out the tax benefits that you get from investing inside a retirement account instead of just investing in a regular brokerage account. So you might have access to an employer-sponsored retirement account if you are working right now. Your employer isn't required to offer it to you, but most employers do offer retirement accounts as part of their benefits package. So it might be called a 401k if you work for a private company. It might be called a 403b if you work for a school district or something like that, a public institution. You might have access to a 457 if you work for the state or the federal government. You might have a simple IRA if you work for a small business. The different numbers, they refer to the part of the IRS code that creates all the rules around these accounts. So pretty much anything with a 4 in front of it is an employer-sponsored retirement account. But all of these different numbers, and there are more in addition to this, they refer to the part of the IRS code that lays out the rules for each account. But these are employer-sponsored accounts. It means that you're only allowed to put money into these accounts when you are employed by the employer. Once you leave your employer, the account still stays the same, but you're not allowed to put more money into it. So we'll talk about what that looks, we'll talk about kind of rollovers and things like that as we go forward, but this is just the basics. If you're self-employed, you might have a solo 401k, which is just a 401k for a person who's the only employee of their company, or you might contribute to a SEP IRA. Again, all of the rules associated with all of these different accounts are laid out at the irs.gov. So if you really want to know the specifics, there are rules somewhere. Individual retirement accounts, these are a little bit different than employer-sponsored accounts because the individual retirement accounts, or IRAs, some people say IRAs, I usually say IRA, These are attached to you as a person. So the number listed on the account, it's owned by you personally. It's owned by your Social Security number. So you can take these IRAs wherever you go, where it doesn't matter who you're working for. As long as you are alive, these are your individual retirement accounts. They're attached to you. And the two main IRAs are a traditional IRA and a Roth IRA. And we'll definitely talk more about the difference between those two words. Gwen, do we have any questions yet, or should I just keep going?
We have a couple questions, but I think they would be best answered later on.
Wonderful, thank you. So Roth versus traditional. This is typically the first place that people start getting confused about different retirement accounts. So that is where we are going to start. The main difference between a Roth and a traditional account, and it doesn't matter if we're talking about an IRA or a 401k, the main difference is when your money is taxed. If the account that you are putting money into or the account that you own, if it has the word Roth in the account registration, then it's a Roth. If it does not have the word Roth in the account registration, then it's a traditional account. So your traditional IRA, it might be labeled traditional IRA, or it might just be labeled IRA. Your Roth IRA will always be labeled Roth IRA. Hopefully that makes sense. But if you don't see the word Roth in the registration, then it's a traditional account. If you do see the word Roth, then it's a Roth. So let's start with our traditional. In a traditional account, your contributions, a contribution is something that you as the investor, you put the money into the account. That's a contribution. Contributions into a traditional account are made pre-tax. So that means you don't pay tax on the money that you earn. You earn some money, you can put all of that money into the traditional account without paying taxes on it. Then you take your contributions, you invest your contributions in something. The idea is to grow those investments over time. When you make a distribution, which means you make a withdrawal from the account, your distributions are taxable when you take the money out. So hopefully that makes sense. You don't pay tax today. You put the money in the account. It grows and grows and grows. When you take the money out of the traditional IRA, that's when you are taxed. Sometimes these are called tax deferred accounts. You're deferring the tax to a future time. So that's what makes a traditional account a traditional account. Now we can compare that to a Roth account. If you are putting money into a Roth account, your contributions go in after tax. So you earn money, you pay taxes on those earnings, you send your taxes off to the IRS, and you put the leftover money into your Roth account. So it's post-tax money. Again, you put the money into the account, then you choose the investments. The investments hopefully grow over time if we're doing it right. Then when you take the money out, when you take a distribution, the money that comes out is tax-free. So you pay taxes today, put the money into the account, it grows and grows and grows. When the money comes out in retirement in the form of a distribution, it comes out without owing taxes. So that is the difference between a traditional account and a Roth account. It's the timing of when you pay the tax. Do you have any questions on that? I went through that a little bit quickly, Gwen, but do we have any questions on Roth versus traditional?
I just actually got one that might be helpful to address right now. So someone just asked the question, it seems like the Roth is like more advantageous. Why would someone invest in a traditional IRA over a Roth?
Yeah, that's a really, really excellent question. There are some rules of thumb, And this is definitely an area where you need to know your own situation more than you need to know a rule of thumb. But generally speaking, the idea is that if you can pay taxes today at a relatively normal tax rate, so I don't know, you're just kind of like in maybe one of the first 4 tax brackets, and you just earn like a normal income, you probably do want to just pay your taxes today, invest the money, let it grow, assuming that you have a long period of time for it to grow, and then take the money out tax-free when you reach retirement age. So it's a function of what's your tax rate today and how long do you have to grow the money. If you are a high income person and part of your money starts being taxed at, let's say, the 35% tax bracket. So your income is high enough that you're in the 35% tax bracket. Then you have to think a little bit about whether you expect to always be in the 35% tax bracket, or when you are retirement age, is there a chance that you will be in a lower tax bracket? So if that's the case, if you're a relatively high earning person or a high earning household, it might make sense to avoid paying the taxes today while you're in the 35% tax bracket, defer that until you hit retirement age, and then you make the assumption that, okay, well, I'm not working anymore. The amount of money that I pull out of my retirement accounts will keep me in a lower tax bracket. So I've avoided paying taxes at 35%, and instead I'll pay them at 22% when I'm in retirement. That's typically when people start choosing the traditional over the Roth. So there's a little bit of like a tax bracket arbitrage that people can think about. I will say that this is, in my opinion, not the question that you really need to spend a ton of time on. We're always trying to do the best we can to know the tax bracket we're in today and the tax bracket we might be in the future, but we're guessing about tax rates in the future, right? Especially if you are early career or mid-career. If you're 30 years old and you're trying to figure out what tax brackets are going to look like when you are 60, you are just guessing. It might be similar to what the tax rates are now, or they might be completely different. So, and I've kind of said this in the past, that don't get hung up on traditional versus Roth. If it's something that seems overwhelming at this point, then just pick one. Just pick one and put your money in there, and then read as this concept becomes more clear in your head. Either way, the very first most important thing is to save money, put it into a retirement account, and invest it. And then some of these tax issues you can work out as you continue to learn more about investing. That's a really good question, though. And definitely submit a question, and we can come back to question and answer as I get through the slides. So if we're talking about optimization, optimization number 1, in my opinion, is be as aggressive as you can. And that doesn't mean be as aggressive as it's possible to be. It means you figure out what your tolerance is and figure out how you can use these retirement accounts and get them to grow as big as you can. So be as aggressive as you can be, not as aggressive as it is possible to be. I hope that distinction, especially having gone through March 2020, that distinction is important. So I'm going to show you guys some numbers here and show you where I think that this ends up being really important. So I know some of you have seen this before. So we're just going to go through it again. You guys know I love it. You know I love time value of money. So this is showing compounding growth over time. So what we have here is just this scenario analysis. We're going to use the concept of time value of money to calculate what we think an account might be worth in the future. If you've taken Finance 101, you will learn about time value of money. The idea is that you have 5 inputs, and you make assumptions for 4 of the inputs, and then you solve for the 5th one. This is the concept that every single retirement calculator, amortization calculator, loan calculator, all of these things are just a different version of a time value of money calculation. So the 5 inputs that we have in time value of money are present value, what something is worth today, rate of return, that's how fast we expect something to grow over time, payment, when you're saving money in a retirement account, this is a positive number. When you're pulling money out of a retirement account, this is a negative number. I'll explain why it's 0 in this example just in a second. Number of years or number of periods, that's your 4th input. And then the 5th is future value. So again, the idea is you come up with assumptions for 4 of them. I don't have my financial calculator on me right this very second. Use a financial calculator. You can put one of these together using Excel. You can use you can just Google time value of money calculator. Here, we are calculating what we think the future value of an account might be under different assumptions. So we're starting with a present value of $10,000. You have $10,000 to invest today. That's what your present value is. Here in the upper left-hand corner, we're looking at an investment that we think will get a 5% rate of return every year on average. It doesn't have to be 5% exactly every year. It just has to average out to 5% per year. In this scenario, we're not putting any money into this account, but we're not taking any money out. And then we're going to let this account grow for 10 years. So when we plug those numbers into our time value of money calculation, we come up with a future value of $16,289. So by making this decision to take our $10,000, we're not going to spend it, we're going to invest it, and we target an investment we think gets a 5% rate of return, and we do it for 10 years. When we come back in 10 years, now our $10,000 is worth over $16,000. So we've gotten additional growth by investing. This is what investing is. If we go over to the upper right-hand corner and we have our $10,000, our 5% rate of return, we're not putting any money into the account, we're not taking any money out, but now we let it grow for 30 years instead of 10 years. Now we have a future value of $43,219. So that should make sense, right? Because it's compounding for longer. So we end up with more money. This is showing that time has value. That's why it's called time value of money. So we have more money because we let it grow, growth on top of growth on top of growth for a longer period of time. We come down to the bottom left-hand corner, we have our $10,000, but now we're making a different choice. Instead of something that we think will get a 5% rate of return, now we're targeting something we think might get a 10% annual rate of return. Again, we're not putting any money in, we're not taking any money out of this account. When we come back in 10 years, this account is worth $25,937. So this should make sense too, right? Instead of, because we have a higher rate of return, we should end up with more money over those 10 years. So we do, instead of having $16,000, we have almost $26,000 because we invested in something that got a higher rate of return. So now in the bottom right-hand corner, going back to the example one more time, $10,000, we're sticking with that investment with a 10% rate of return. We have no money going into the account, no money coming out, but now we're letting it grow for 30 years. So this is where, if I'm doing it on the whiteboard, or if we're in a class, or if we're in an in-person meeting, I would ask you all to guess what the number is based on what you see on the screen. So you can just kind of do it in your head. Like, what would you expect this number to be? Most people guess $80,000, $100,000. But because of the power of time value of money and exponential growth, it's actually $174,494. This is really, really important for all investors, especially the people on this call, to understand in finance and investing the power of exponential growth. Like in the world, most of us deal with linear growth. and we don't have very many examples in real life of seeing exponential growth in action. Like, how many times does something double? 1 turns into 2, 2 turns into 4, 4 turns into 8, 8 turns into 16. That's what the concept of exponential growth is telling us. So I always show this whenever I can, just to show people that the difference between targeting and achieving a 5% rate of return over 30 years, which is a reasonable and fairly conservative target rate of return over a 30-year time horizon, versus targeting and achieving a 10% rate of return over a 30-year time horizon. Most of us, when we're saving in retirement accounts, the idea is that we're in our careers at some point, right? And we are saving for a period of time that's far in the future, right? So if I'm 40 and I plan on working until I'm 70, that's a 30-year time horizon. If you're 25 and you're working, you might be working 50 years or 55 years, whatever it is. But even a 10-year time horizon is a pretty decent period of time. One of the other things to consider is that most of us, you're saving in your retirement accounts, and then you go through this retirement transition period. Most people don't go to cash when they hit retirement age, because you actually need your money to keep growing for the rest of your life. And I think most of us expect and hope that we have a long retirement. So that 30-year time horizon, maybe not if you're 90, maybe not if you're 80, but if you're 60 or 65, you might need to start thinking in terms of decades instead of, well, I'm going to retire in 5 years or 7 years. So just kind of keep that in mind too. This is just to illustrate the power of compounding over time. And that when you're making those decisions, and this is, it's every person has to do this for themselves. How much of my money can I put at higher risk with the expectation of a higher rate of return? And it might be 10%, it might be 50%, it might be 70%, and everybody has to figure that out for themselves. But if you consider yourself to be a more conservative investor, there's a really good chance that you're going to have to save more money. That to get to the end goal of having the nest egg that you need to have a comfortable retirement, either you have to save the money and keep it very safe and steady, or you need to ask your investments to grow for you. And so there's this tricky, there's this difficult decision making that comes into deciding how much money are you able to save or needing to save versus how much growth do you need or want your investments to provide. Because there's a big difference between a 5% rate of return over 30 years and a 10% rate of return over 30 years.
Hey, Sarah.
Yeah.
I've seen a couple of questions that came in, one about the calculations on this slide.
Mm-hmm.
And somebody was wondering about if these calculations account for depreciation, and if there is anything that you can say about like what happened in the market with the pandemic and the depreciation that happened, and if it has any impact on the way that we should consider the calculations here.
Am I thinking of the word depreciation as the question, does it account for declines in the stock market like we saw in March? Does that sound like what the question is?
I think so, yeah.
The answer is yes, it accounts for that. And we'll look at charts that show the stock market over time, that your estimates of future returns take into account the likelihood that there are going to be dramatic declines, especially in the stock market periodically. So yes, this takes it into account. The question I thought you were going to ask that I'll address right now that people typically ask at this part is, does this take inflation into account? And on that question, I don't know if any of you actually have this question, but I'll just assume that someone does. These numbers are showing something we call a nominal rate of return. So just the actual numerical mathematical calculation of how much something grows over time. One of the things that we're all experiencing as we go through life is the experience of inflation, the idea that the things that we're buying are getting more expensive over time. So in all of these scenarios, there's a rate of inflation that I'm not adjusting for in this calculation. So the $10,000 growing at 5% per year over 30 years actually grows to $43,000, but 30 years from now, that $43,000 won't be able to buy as much as it does today because of inflation. Does that make sense? But with inflation, if that is a concern, and these are kind of two sides of the coin when you're investing. One, you have to worry about the decline in prices, right? That might happen either temporarily or permanently. But then you also have to be considering the impacts of inflation on your lifestyle over time. Both of these, a 5% and a 10% nominal rate of return, you take your nominal rate of return, you subtract out the inflation rate, and once you subtract inflation from your nominal rate, you get something called a real rate of return. Your real rate of return is actually what's the most important thing in investing. If you're investing in something relatively safe, that gets a 2% return over time, and inflation is 2%, rate of return is 0. You are keeping pace with inflation, but you're not actually growing your wealth, right? You're just keeping up with the rate at which things are increasing over time, the price at which things are increasing over time. If you are really, really conservative and you have all of your money in a savings account at 0% and inflation is 2% per year, you're actually losing 2% of your wealth every year. So with this idea of safety versus growth, there are all of these subplots to the story that get layered in that you need to start being aware of as you're making your investment decisions. So again, I know that wasn't actually a question, but I felt compelled to kind of go off on that tangent, because most people in the back of their minds, especially if you're accounting for something far in the future, you should be asking yourself, okay, well, if I have $43,000 today, how much will that buy me 30 years in the future? It'll probably buy you half. The purchasing power will probably be cut in half by then. So are you investing in such a way that you're actually increasing your wealth over time? It's really important, especially for people with long lifespans, right? And if we take women in the aggregate, it's definitely something we need to be thinking about when making investment decisions. So I'm going to keep going on the retirement accounts. Again, this is kind of like a side topic related to retirement accounts, but I'm going to keep going with the retirement account theme, and then we can come back to compounding and time value of money and rates of return as we go down the slide deck. So we talked about how with your retirement accounts, you're putting contributions in, and then you're choosing the investments once you put your contributions into the account. So I think that one of the ways that you can get to this idea of what should I be investing in, the way you get there is you need to ask yourself two questions. One, when do I need the money? So that goes back to the previous slide. Do you need to pull this money out of the account in 5 years? If you need to pull it out in 5 years, then it should be invested in something that's relatively conservative. If you need to pull it out in 30 years, you might be able to invest it in something that's more aggressive. The second question is, can I tolerate big swings in price? I mean, we just had a pretty good litmus test in March 2020. Can you tolerate big swings in price? Can you, if you're investing in stocks, which is where I get that 10% number, and I'll show you the chart in a second. If you're investing in the stock market with an expected annual rate of return of 10%, can you stomach a 34% decline in 18 trading days, right? Which was unprecedented and terrifying, and something that's not out of the realm of possibility because it happened. It had never happened in the past, but it happened. So that big swing in price has to be something that you can tolerate. And this is not a function of your age. This is not a function of, or not so much a function of your age. I feel like I've met plenty of conservative young people and plenty of people near retirement age who are relatively aggressive. And it's more of a function of your personality and probably what you have learned about investing to date, either from your family or your friends or wherever people learn about investing. But you have to know that for yourself. Can I tolerate the big swings in price? If the answer is no, then you'll want to invest more conservatively and save more money. Or if the answer is yes, I can tolerate big swings in price, you will hopefully be able to get through those crazy March 2020 time periods and come out the other side and continue along that path of 10%. Maybe it's not 10%, 8, 9, 10% growth over long periods of time. Stocks have higher returns over time, but the price bounces around a lot. I feel like I do not need to belabor this point. If you're here, you were probably paying attention in March 2020. The prices of around a lot, sometimes up, sometimes down. That's just what the stock market is. Bonds have lower returns over time, but their prices are more stable. So that appeals to a lot of people, right? Like, okay, I don't want to be on the roller coaster, even if it means I might end up with more money over time. I'd rather, kind of be a slow and steady wins the race type of person. You have to figure this out for yourself. Stocks require a very long holding period because of the decline. I've been teaching some version of this class since 2011. And so since then, we've really had major downturns. The first quarter of 2016, the last quarter of 2018, and then in March, right? So you have declines in the stock market, not infrequently. If you're in the stock market, you just need to know that it's part of what investing in the stock market is like forever and for all times. There's not going to be a really long time where you go up fast and straight. It's lots of ups and downs. And we've got some charts that are coming up that illustrate that point. So knowing those things, part of this whole process through time is figuring out what percentage of stocks versus bonds. Maybe there's some real estate thrown in there. Stocks versus bonds versus real estate. What makes the most sense for you? So here's my risk versus return chart. I love this chart. This is updated through the end of 2018. Actually, I think this might be through the end of 2019. And so what this is showing, regardless, it's a long time horizon. So what we have here on the y-axis going up and down, we have compound annual returns. So this is the R in our calculations. This is the rate of return that we're expecting to get from different asset classes. On the x-axis, going along the bottom, we have standard deviation of annual returns. The standard deviation, that number is trying to tell us how volatile the price of an asset is over time. So in the bottom left-hand corner, we have two low risk. Oh, and also risk is, in investing, risk is usually illustrated by standard deviation. So standard deviation is our measure of how risky something is. It's how much the price bounces around in the short term. So in the bottom left-hand corner, we have the asset class of cash. right? So what if you just put your money in a high yield savings account? And US bonds. A bond is a loan that you're making to a company or a country, someone like that. So on this chart, we see that it's relatively low risk. It has a relatively low standard deviation, which means relatively low volatility. And in exchange, we get a relatively low expected rate of return, a relatively low compound annual return. So this is where that 5% number comes from in my example. We have cash and bonds in the lower left-hand corner, low risk, low expected return. As we go out on the standard deviation of annual returns axis, now we're getting into asset classes where the prices are going up and down by a lot. In the upper right-hand corner, we have a diamond for large US stocks. So this is the S&P 500. We have small US stocks. It's the Russell 2000. And we have real estate. It's really, really important. And I want to point this out. Usually it's in my footer, but I didn't have room here. This real estate is commercial real estate. It is not your house, even in Austin, not your residential homestead that you live in. This is commercial real estate. So think office buildings, apartments, malls, things like that. In that upper right-hand corner, you have that cluster of assets that are high risk, and over this time horizon from 1994 to 2018, you were compensated with a higher rate of return. This is the risk-reward trade-off in a chart. For these asset classes, if the future is similar to what it's been like in the past, then you would expect that for taking the higher risk of investing in asset classes that bounce up and down in price by a lot, you'll be compensated over time. Now, this isn't a guarantee. It's not, never ever think in investing that if you take more risk, you will definitely get a higher rate of return. Here we have a couple asset classes that show that it's not a law. So over here we have non-US stocks, so international companies that we could buy as US investors. And then we have commodities. Commodities are raw materials. So in Texas, you think oil and gas, but it's also things like timber, corn, soybeans, things that get used up. They get either grown or pulled out of the ground, and then they get used up to do something else, to consume them. So commodities is really the asset class here where you're looking at this like, oh my gosh, okay, from day to day, from year to year, the volatility of prices is very, very high. It's way out there on the risk spectrum. And over this time horizon, you were not compensated with a very high rate of return. You weren't compensated with a rate of return similar to cash. You would have been better off investing in cash than investing in commodities over this time horizon. So we use this chart, I use this chart to illustrate, okay, over long periods of time, again, if the future is similar to the past, it doesn't have to be exactly the same, it just has to be similar. We would expect that going forward, over decades, US stocks would have a higher rate of return than cash and bonds. So you would make your decisions accordingly. Again, it's not a guarantee, it's an expectation. So again, this is where that 10% over long periods of time, that 10% number comes from versus the 5% number, especially along that 20, 30-year time horizon. So the idea is that in your retirement accounts, you're taking this into account. How much do I want these investments to grow over time? I'm putting money into the accounts, I'm investing in something. In a 401k, you have access to stock funds, bond funds, a money market, which is similar to cash, international stocks, and maybe real estate. So you can choose the mutual funds in your 401k to get you invested in those asset classes that we just talked about. I will say that the first option for most people, especially if you're a beginner, are these target date funds in your retirement accounts. One of the greatest things that has happened over the last 10-ish years is the default on 401ks became a target date fund instead of cash, where you have to opt out of a target date fund. And what that really helped with was this idea that especially a beginner investor where this isn't really your thing, you sign up for your 401k, you start putting money into the 401k, and you don't realize that you need to take an additional step of investing the money. I've seen people come through my office, especially at the beginning of my career, where they came in with old 401ks that were still invested in cash from when their contributions were put in there in the 90s. That doesn't happen so much anymore. Now, when you sign up for your 401k, the default option is going to be a target date fund. So we'll spend a little bit of time on that. Because most retirement accounts now have a target date fund to choose from. So target date funds choose your stocks, bonds mix for you based on what year you think you're going to retire. And then they automatically change your exposure to stocks versus bonds as you get closer to retirement age. So this idea that, okay, if I'm not going to retire for another 30 years, it's probably in my best interest to be more aggressive now so that my money gets a chance to grow over those 30 years versus if I'm going to retire in 5 years. So here I just wanted to show you the asset allocation or the difference or the percentage of stocks versus bonds in a Vanguard Target Retirement Fund. So over here on the left, we have the Vanguard Target Retirement 2025 Fund. So this is assuming, like, man, you're really getting close. Like you're going to retire in 5 years. So according to Vanguard, it thinks that your asset allocation should be 60% stocks and 40% bonds and cash. I mean, so notice that that's not 0% stocks or 5% stocks. It's still 60% stocks because Vanguard it's assuming that you are going to live past your retirement date, right? And you're going to need your money to grow over your lifetime, not just the time you're working. So Vanguard is saying, okay, if you should retire in 5 years, we think that you should be at 60% stocks, 40% bonds and cash. Over here in the 2040 fund, it's saying, okay, we think that if you're going to retire in 2040, your allocation should be 83% stocks and 17% bonds and cash. So a much more aggressive allocation. You can get, if you're having trouble coming up with what you think you want your percentage of stocks versus bonds to be, you can definitely cheat and just go and look at Vanguard or Fidelity or whoever has these target date funds and see what they think. One thing I do want to point out with target date funds, every fund family, so every company that's putting together these target date funds for you, they all have different ideas as to what your percentages should be. Some are much more aggressive and some are much more conservative. You can find the breakdown between stocks and bonds by either going to the website, in this case, Vanguard's website, or by using something like Morningstar. Go to morningstar.com, type in the fund that you're looking at, and it'll give you a pie chart like this that shows you what percentage of stocks versus bonds is in your target date fund. I'm going to stop there for a minute, Gwen, and see if see what questions have popped up.
Yeah, so I actually received a question specifically about this Vanguard Target Retirement 2040. So someone asked the question, and I want to make sure that I get this right. So if you're the person that asked this question, you can unmute and let me know, hey, that's not totally right. But it says, I recently left my government job and I have a TSP account. I was informed that I can transfer any funds and other accounts to the TSP account. So now I'm not sure if I should keep the other funds in my Vanguard Target 2040 or transfer it to the TSP account. Do you have any thoughts on what I should consider?
So did you started out by saying this person is leaving their federal government job, right?
They've already recently left the government job.
The benefits of the TSP plan specifically for federal employees is that your investment options are super cheap. Just obviously the federal government with a very large workforce has really good bargaining power, and the options available to you in the TSP are really, really inexpensive. That said, your options at Vanguard are also very, very inexpensive. So I would say that from a cost perspective, you probably aren't going to get a huge benefit from consolidating into your TSP because your Vanguard funds are already very inexpensive. Even the target date funds are very inexpensive. If it's a matter of convenience, then it might make sense. But I would say that, I mean, without doing like a really long analysis of it, if you're just looking at investment options plus cost, the TSP is cheaper, but Vanguard is also very cheap. So you're not talking about saving a ton of money if you went from Vanguard to TSP. Does that answer that question? And if I didn't, I'm going to put up my my email address at the end. I will answer any questions that I can at the that are kind of more personal questions or more specific questions to you. So that's for everyone. If you have kind of a more specific question, then definitely use my email, and I'll look at all the questions that come in.
And then we've got quite a few questions, but I think they'll make more sense after we cover the other optimizations. But one last question for right now. So in retirement, how are you placed in a tax bracket for a traditional IRA? Is that based on minimum distributions, or is there another number that they take into account?
Yeah, that's an awesome question. When you are retired, you have kind of all of these different sources of income, right? You're probably going to file for Social Security. Some, but not all, of your Social Security is taxable. If you get a pension from somewhere, like if you ever work for the city or the state or school district, you have a pension, that income is going to be coming in, and that's taxable. And then whatever amount you take out of a traditional account is also taxable. So you can look at the front of your tax return and see the boxes for each category of income. So income, while you're working, your income is your W-2 wage or salary. But in retirement, it's typically Social Security, a pension if you get one, and distributions that you take out of a traditional IRA or 401k, a traditional account. And there might be some other sources. Maybe you have rental income, that's taxable. So if you know what your sources of income are each year, and if you're trying to match up your income with your expenses in retirement, you should be able to come up with a pretty good projection of what your tax bracket is. If you need $100,000 a year to pay the bills and just live your life, then you'll need to figure out where does $100,000 worth of income come from, right? Or if it's not income, what am I selling and turning into cash in order to turn it into $100,000? But as you're in retirement, or getting close to retirement, it really does start making sense to pay attention to that first page of your tax return so that you can see what is taxed as income. All of your distributions from a non-Roth traditional IRA is taxed as income. So that will get fed into the formula that determines what your tax bracket is. Does that make sense?
Sarah, even the Social Security in the states that it's not getting taxed, would that still be counted? towards his taxable income?
Some percentage of it does, depending on your tax bracket. So all of these things kind of feed into each other to determine what your tax bracket is, but it is possible to do projections to figure out in what tax bracket do you think you're going to land in retirement. Hopefully that made sense.
It does, thank you.
Yeah, for those of you who used the extended tax deadline to July 15th taxes from 2019, this is a perfect opportunity. If you have someone preparing your taxes, or if you're doing it with TurboTax, print out the first page and look to see what gets categorized as income. That's what determines your tax bracket. If you had $1 million in a savings account and your idea was just to use your savings account to live off of for the rest of your life, none of that would be income, because it's all savings that's already been taxed. It already came from somewhere. You would just be drawing it out of the account and living off of it. So it does make sense to start asking those questions as you're getting closer to retirement age, like, well, what actually qualifies as income and gets taxed as income? And then the other things that you have going on, how do those things get taxed? Maybe they don't get taxed at all, or maybe they get taxed minimally. But definitely distributions you are taking out of your traditional IRA are definitely taxed as income. And just to, I don't know if I have this in another slide, once you turn, now it's age 72, but if you started taking required minimum distributions a couple years ago, well, let's just assume now that it's age 72. Starting at age 72, they start making you take money out of your traditional IRA or out of your 401k. It's called a required minimum distribution. And that is also knowable, and you can make projections. You take the balance of the account, you multiply it by a number that's given to you by the IRS, depending on your date of birth, and then you calculate your required minimum distribution. So there start being a lot of questions about distributions from IRAs, and maybe we can kind of punt those towards the end if people have questions about what that looks like. But all the money that comes out, I should say, it's usually all of the money that comes out of your traditional IRA or your traditional 401k is taxable. There are a few exceptions, but I'm just going to kind of leave it like most of the time, the money that comes out of your traditional IRA or your 401k is taxable as income. Really good questions. All right, I'm going to keep going here. Oh my gosh, we're only on optimization 2. I think I only have 5, maybe 4. I think I have 5, so I think we're still on schedule. Okay, so something else to really use these accounts to your advantage. The first one is whatever amount you're putting into the retirement accounts, be as aggressive as makes sense for you, because we want your retirement funds to grow as much as you can possibly tolerate so that you have enough money in retirement. Second optimization is think about increasing your contributions. Here, especially for beginners, small changes have big effects. So let's just assume you're on this call and you're like, oh, I've never started a retirement account before, so the present value of my 401k is 0. So I'm assuming that you haven't really started saving yet, and that you have access to a 401k. If you don't have access to a 401k, let's call this an IRA. Well, let's say the present value of your retirement accounts is 0 as of today. Now let's assume that we're going to run these calculations over 15 years of saving and investing. So that's 180 months. And we're investing in some mix of stocks and bonds that we think will get a rate of return of about 7% per year for those 15 years. Hopefully you guys are with me. I'm kind of setting this up according to the time value of money calculations that we did earlier. So the 7% rate of return is probably appropriate for something like the Vanguard 2040 fund or the Vanguard 2045 fund. Let's say you start off making $500 contributions. So your monthly contributions are $500. By the end of year 15, we would expect, using time value of money calculations, we expect your accounts to be worth $158,481. And after 30 years of those assumptions, saving $500 a month, getting an annual rate of return of about 7%, then we expect in year 30 that your account is worth over $600,000, $609,985. That's awesome, right? Like you made this decision to save $500 a month, to invest it relatively aggressively, and then give it 15 or 30 years to do its thing. Now over on the right-hand side, let's assume instead of $500, you choose $600. So an additional $100 a month over that same time horizon. The $600 a month grows to $190,000 and change. That's a lot more than 158. Over 30 years, your account grows to $732,000 instead of $609. So now we're talking about a relatively small change that leads to tens or hundreds of thousands of dollars in difference over long periods of time. So when you are making the choice, how much should I save? I mean, really the answer is like, how much can you save? And then save a little bit more than that. The answer is save as much as you can. And every little bit helps. If 500 is comfortable and 600 is a stretch, try to get to the 600, because with time value of money, the idea is you'd end up with quite a bit more money over those 15 or 30 years. So these small changes that we're making today have a big difference. All because of exponential growth and compounding and time value of money. The easiest place to make these changes is in your retirement accounts, especially if it's a 401k or something like that, 401k, 403b, because the money is taken directly out of your paycheck. I didn't point that out before, that when you have an employer-sponsored plan, your employer takes your contributions out and puts it into your retirement account before they even send you your paycheck. So you will eventually build up, your budget will eventually adjust to that smaller amount. And in exchange for doing that, for spending less money, for having less money to spend and spending less, you'll end up with more money. So I think that that's really, really important. Here are your contribution limits for 2020. So for your employer-sponsored plans, your 401k, your 403b, your 457, you can contribute up to $19,500 per year if you're under the age of 50. So again, this is the money that you are setting aside. This does not include your match. This is just your contributions. Your match goes in on top of this. I also failed to mention before that with a lot of employer-sponsored plans, you put in money, and then as an incentive, your employer might put in some money on top of that in the form of a match. But these contribution limits only account for the money you put in. If you're 50 or over this year in 2020, you can put in something called a catch-up amount, and you can put in up to $26,000. For your simple IRA, which is another small business retirement plan, you can put in up to $13,500 and then get your match on top of it. Or if you're 50 or over, you can put in $16,500. With your SEP contributions as a self-employed person are based on a percentage of your compensation. So this is a calculation that your CPA or TurboTax, that they will do for you every year. Like, okay, you are a realtor, you made $300,000 last year, you can put in $57,000 into your SEP on a pre-tax basis. So it lowers your tax bill, and you can put in this big chunk into your SEP IRA. Your individual retirement accounts, one of the drawbacks to not having an employer-sponsored plan is that IRAs have a much smaller contribution limit. So for individuals under the age of 50, you can put in $6,000 a year, $7,000 if you're 50 or over. And for the whether you have the option of let's say you're at a job and you have a 401k and you have a traditional 401k and a Roth 401k to choose from. Your $19,500 limit applies to both. So you could put $10,000 into your traditional IRA to lower your tax bill and $9,500 into your Roth to equal $19,500. If you have another job and you also qualify for a 401k at another job, you can't contribute to it. You, as a person, as an employee of someone, can only put in $19,500 into a 401k. You, as a person, can only put in $6,000 into an individual retirement account, whether it's traditional or Roth. So you can't have, it's not $6,000 per IRA, it's $6,000 per person. So hopefully that makes sense.
We do have a couple of questions about contributions. The two that I have are contributions to 401ks. So the first one says, so my employer made the decision to not contribute to our 401ks for the rest of the year at least. Sara, can you speak in general terms about contributing a larger amount than what the company matched?
Yes. So that is going to be really common this year, and it might be common into next year, into however long. And businesses are fighting for survival. The first place where they can cut costs is not match your 401ks or your retirement plan. It saves them money, and hopefully they don't have to fire people, right? So that is going to be a really common theme. Going back to the idea of you or someone need to contribute enough money to your retirement accounts in order to run those time value of money calculations to get to the goal that you need to get to. So I would say that if you were contributing, let's say you make $100,000 a year, and you were contributing 3% or $3,000, and you were getting matched 3% or $3,000 for a total of $6,000 a year going into your retirement accounts. If your retirement goals necessitate a $6,000 contribution every year in order to meet your goals, you are going to have to go in and replace that match that just got taken away. Or otherwise you're going to fall behind. Does that make sense? So definitely keep an eye out for that. When I'm doing calculations with people on how much money needs to be saved in that payment bucket from back here, this payment number here, I assumed it's 0, but usually it's these monthly contributions. When we calculate that payment amount, I ask people, how much do you put into investment accounts or retirement accounts, and then how much do you get matched? And that total amount goes in the payment calculation and flows through to, okay, well, here's the future value of how much you could expect at the end of year 30. So I would say if the monthly contributions, let's say on the right-hand side on the monthly contributions, 300 of this per month is your contribution and 300 a month is your match. If that match goes away and you don't replace it, then you're not going to end up with the $732,000 at the end of year 30 because your monthly contributions are smaller. So there is a chance that you might have to look at that really closely and say, man, I was counting on that $300 a month match. Okay, now I need to go in and save more money to replace it to keep on my retirement track.
The second question is, Sara, do you know if you were furloughed, can you contribute towards your 401k from your savings account?
You can't. I know you cannot cut a check from an outside account into your 401k. It comes from paycheck withholdings. So if you're furloughed and not getting a paycheck, if the expectation is that you go back to work at the end of this year, you might need to catch up on your contributions by withholding a larger percentage from your end of year paychecks to hit the same goal. So in that case, what you would do is you have your savings, you would live off of your savings and be drawing that account down because your paychecks are smaller and more of your paycheck is being deferred into your 401k in order to get to the same savings goal that you had at the beginning of 2020. That is something that you might have to do, but you will have to go in or call HR or do the calculation and say, okay, before I was furloughed and my normal paycheck, I would withhold 10% of my paycheck and contribute that to my 401k. Well, then I missed a whole bunch of paychecks. And now once I start receiving a paycheck again, well, now I have to catch up in order to get to the same amount I was going to save by the end of the calendar year. So now I have to withhold 20% of my paycheck, and my paycheck is a lot smaller. You would use your savings to supplement your paycheck, and it's like a backdoor way of putting your savings into your 401k. Does that make sense? That again, like because of things being what they are now and in the future, that's a really creative solution to keep on the same investing path, but you'll have to do it in a slightly wonky way. Because your 401k, you can't say, oh, like I'm just going to cut a check and send it to my 401k company. That's not how the contributions are made. It goes through your payroll. Really good questions. Should we keep going, Gwen?
Yeah, I think we do have quite a few questions, but I think they'll be addressed, or we can address them in the next optimization.
Great. Okay, number 3, reduce your fees. Ways to reduce your fees in your retirement accounts. Okay, the first thing you need to do is look at the cost of the mutual funds inside your retirement account. So first I'm going to talk about 401ks. With your 401k, your investment options are given to you. There's just a list of funds that HR gives you. They say, hey, you can choose from these 35 funds. Which ones do you want? On that sheet, they'll give you the names of all the funds. There's also something called an expense ratio. That's for each fund. That's how much does it cost this company to run this mutual fund for you. So the fees for the mutual funds might be 1% per year, or they might be 0.05% per year. As you get along and you're looking to, when you're investing, it's not what you make, it's what you keep. Once you start moving along this path, this starts becoming a little bit more of an advanced topic to go into your 401k and say, okay, these are the options that I chose 5 years ago. Are they still the best options for me? If you're paying someone 1% per year, that's a lot. That's a lot for a mutual fund. We would call that a relatively high cost mutual fund. You would want to take a very close look at that mutual fund and see if it did a better job at investing than the cheaper options that you have available to you. So you can look at, typically I look at 10-year performance. So over 10 years, was the rate of return on this fund than it was on some of these cheaper funds, which are probably going to be index funds. So know the management fee for the funds that you're investing in and figure out if it's worth it. Are you getting value for the additional money that you're paying for the funds that you're investing in inside the 401k? If you can, take a look at using index funds. That's the second thing here. Most 401ks now have a S&P 500 index fund option. and it should be very inexpensive. And it's just a way for you to track the market. That's how we say. So if the S&P 500 goes up by 1%, then your mutual fund will go up by almost 1%. If the S&P 500 falls by 1%, then your mutual fund falls by 1%. So see if you can start incorporating lower cost index funds into your 401k instead of just choosing either the pre-chosen ones that were chosen for you or the ones that you chose at the beginning of your career because you just like chose them randomly. Go in and really start examining the fees and make sure that if you're paying a relatively high fee, you're getting something, i.e. performance, in excess of the fee that you're paying. It is possible. You just want to take a look at it. One thing we've talked about in the past here is this idea of unbundling your target date fund and then redistributing with index funds. And what I mean is this. If you have Vanguard target date funds in your 401k, Vanguard only charges you 0.19% or something like that, 0.19% to put together this basket of 4 other mutual funds into like one bundle, one-stop shopping. That's what your target date fund is. There are other fund families. In fact, most other fund families will give you a target date fund, but the fee might be relatively high. So if another fund family, I don't really want to name names, another fund family has a target date 2040 fund, and you look at that fund and it charges you 0.75%. And you look a little bit closer and you're like, okay, this fund is basically 80% stocks, 20% bonds. You could recreate that target date fund using the index funds available to you in your 401k. So you log into your 401k, you basically sell the expensive target date fund, buy 80% of the S&P 500 index fund and 20% of the total bond market fund or whatever generic bond fund is available to you, and save the 0.75%. So now you just made an additional 0.75%, maybe 0.7% every year for the rest of the time you're investing, which is a pretty big improvement. If you're looking at your choices in your 401k and all of your choices are relatively expensive, call HR and see if they can call the plan administrator and get some cheaper options available to you. I think there's someone in the group who did this, and unfortunately then she was tasked with finding a new plan, a new cheaper plan. So hopefully you won't just be creating more work for yourself, but typically whoever puts the retirement plan in place is not a retirement plan professional. They're just a person doing the best they can to make a plan available to employees. Room here for, as an employee, for you to contact HR or the plan administrator of your plan and kind of lobby for less expensive options. So definitely reach out and try to do that. Try to get more information about your plan. Try to see if there are other investment options available to you, especially if they're the really low cost index funds. It'll save you money over the long term. And then if you have questions, get advice from a fee-only advisor. So someone who doesn't get paid on commission, someone who just can take a look and give you conflict-free advice.
Just a couple questions that popped up right now. Can you review, Sarah, where we would find the management fees for mutual funds?
Yes. So if we're talking about your 401k or a 403b or a 457, an employer-sponsored plan, wherever you log in for that plan, there should be a fact sheet available to you that lists the expense ratios or the management fees of all of the options available to you. That's definitely somewhere because they have to provide it to you. So it'll be a sheet listing all of your mutual fund options, and then it'll show 1-year performance, 3-year performance, 5-year performance, 10-year performance, expense ratios. They have to provide it to you. So I don't exactly know where it is, but I know it's there somewhere. If you're investing in your own and you have an IRA that has a mutual fund in it, whether you picked it or someone else picked it, look for the ticker symbol. So that's the letters. Mutual funds are 5 letters long. So you look for the ticker symbol VTSAX. You take those 5 letters, the ticker symbol. You go to something like morningstar.com. You plug into the search box, you plug in VTSAX, and you'll go to the part of Morningstar that gives you all of this information on that specific fund, including the expense ratio.
So the management fee is baked into the expense ratio?
Yes, it's usually the management fee, usually the expense ratio is all of the different fees that fund, including the management fee that fund charges. So the management fee is paid to the people that run the fund. There might be something like a 12B1 fee. That's like basically like a marketing and advertising fee. There might be a 12B1 fee. If you're looking at fees specifically and want to see how they're broken out, Morningstar is great at this. They have a whole tab on fees where you can get all of this really detailed information on what the fees are and how they break down between management fees, 12B1 fees, administrative fees, all the other fees. So Morningstar is a really, really good resource for that.
Okay, and then another question is, what does sell your target date fund mean? Does that mean just deleting the goal date, or is there another definition to that?
Yeah, so in this context, I mean, if you have a 401k, so you already have a 401k going, and your main investment in your 401k is a target date 2040 fund. And after you leave this talk, you look at it and you're like, oh goodness, like the expense ratio on that target date fund is 1%. And that seems high. I think that I can buy some other funds that are less than 1%. You would log into your 401k, you would actually sell that fund, and then with the cash, you would buy 1 or 2 or 3 new funds that have a lower expense ratio. But ideally, you would do it in the same percentage between stocks and bonds as the target date fund you just sold. So if we go back here to this target date fund, if I'm in a target date 2040 fund and I do a little bit of research and I find out that this target date 2040 fund is 83% stocks and 17% bonds. If my target date fund is relatively expensive, I could sell it. And then with the cash that I've turned my mutual fund into cash. Now with that cash, I would use 83% of it to buy a stock fund and 17% of it to buy a bond fund. So hopefully that makes sense. We can definitely go back to that in the Q&A. Did that make sense?
Yes, thank you.
Cool, thank you. It's just kind of a tricky way to, like, as you're a DIY investor and as you're getting more, this is an optimization topic, right? This isn't necessarily like you would start out this way. It's if you're already started and you're fighting for every dollar and every percent and every piece of growth that you can, this is a way to fight for those extra percentages. It does take time though, right? It doesn't come totally free. It requires you to do a little bit of time or put in a little bit of time and put in some research. So reducing the fees is just another way you can increase the amount that you keep at the end of the day. Number 4, we had questions on this last time, converting from a traditional to a Roth in low income years. So this is going back to that tax question that we've been spending a little bit of time on. Okay, so let's say you have a low income year. either by your own choice or not by your own choice, you or your tax prep person could estimate how much tax you'd owe in 2020 if you decided to do something called a conversion from a traditional account to a Roth account. So a conversion is what the actual term is called. If I have a traditional IRA, I have the ability to convert as much of that money as I want, convert it into a Roth IRA. But any of the money that I convert is taxable, right? Because I haven't paid taxes on that money yet. So if I have $10,000 in a traditional IRA and I would like to convert $5,000 of it, I will pay taxes on the $5,000 that I'm converting to a Roth. Then, once the $5,000 gets put into the Roth, I can invest it however I want and let it grow and grow and grow. And when I take that money out, if I choose to take that money out in retirement, it comes out tax-free. So you typically want to look at doing this when your tax rate is relatively low. So if you went on sabbatical, if you got laid off, if you quit your job, if you took an extended parental leave, any number of reasons, you went back to school, there's all sorts of reasons that people have low income years. You can take advantage of that. You know, maybe when you're at your regular salary, you are in the 24% tax bracket. But in 2020, for whatever reason, you're not going to have as much income. You might go all the way down to a 12% tax bracket. What if you took money out of your traditional accounts, paid taxes at 12%, converted that money and put it into a Roth, reinvested it, and then let it grow however long you wanted it to grow? That's what a conversion is. This is kind of the time to be thinking about that. Typically, you start doing the actual calculations more towards the end of the year, because that's when you basically know what your income is going to be through the end of the year. It might still be a little bit too soon. It's only June. But you can definitely start thinking about, oh, is this going to be a low income year for me? Does it make sense for me to do a Roth conversion? Any questions on that?
Yeah, so the bulk of the questions that we've received have been about conversions. So I'll go through them one by one, although they might kind of, overlap in content. So this is more of a sort of like a step back. Can you have a traditional and a Roth account at the same time? And is there any benefit to doing this?
Yes, that is a great question. I'm so glad that someone asked it. Yes, you can have a traditional IRA and a Roth IRA at the same time. Your contributions to IRAs are dependent on your income. So this is, again, where you would go to the IRS website and you would see if you qualify based on your income. Do you qualify to contribute to a Roth IRA? Or do you qualify to make a tax-deductible contribution to a traditional IRA? I did kind of skip over that part, but there are rules associated with that in the IRS. You can always have both IRAs. So that means if you were under the income limits for 5 years and you contributed to a Roth IRA, and then you get a raise, and now all of a sudden you're above the income limits to contribute to a Roth IRA, you still keep the Roth IRA. You continue to invest it. You just can't make more contributions to it until you go under the income limits again. So, but you can have both for sure.
Okay, so then if someone converted from traditional to Roth sooner in life, does that mean that they would pay less taxes?
Perhaps. I mean, if you do it early in your career, this is how I would imagine it. if I had a low income year this year, and I put as much money as I could, I took out and made a conversion for as much money as I could in the 12% tax bracket. And then I moved all of that money over into the Roth. Now I can start thinking about that. So I'm 40, and let's say all the money in my Roth, that's really for when I'm 70 and older. So that has a 30-year time horizon on it. And let's say I convert $10,000. In my mind, I'm thinking, okay, I'm paying taxes. Maybe I have to pay $1,200 in taxes to convert that and move the $10,000 over into my Roth. If I'm an aggressive investor, and I am, in 30 years, I expect that $10,000 to be worth $175,000. And I could take out that whole $175,000 tax-free. I mean, that's pretty awesome, right? If I'm 69 and I'm thinking about doing this, I might not have, in my estimates, without knowing for sure, I might not have exactly that much time to grow the money if I'm further on in life. So I might not get that huge benefit of investing $10,000 and taking out $175,000. That doesn't mean it might not be worth it, but you want to look at it a little bit closer. How long do I have? You want to make the conversion so that the time that you have remaining to invest it before you take the money out, you give it enough time to grow and make back all of the money that you just paid in taxes. So hopefully that part makes sense too, right? Because if you're converting the money, you want to make sure that the additional growth that you get in the Roth IRA makes up for the cost that you just incurred to pay the taxes. Otherwise, you're going backwards, right? So just in and of itself, the money coming out of the Roth tax-free might not be enough to justify making a conversion. You want to make sure that the money that you're converting is being invested in such a way that it's expected to grow more than the money that you just paid in taxes. So there are nuances around that. But certainly, like, the earlier you could do a conversion, probably the better. Later on, you kind of, it gets really weird, right? So you have to think about how long you're going to live, or who the money's for. Is it for you, or is it actually your legacy that you're intending to pass to your kids? What's the time horizon that you're putting on this money? When your beneficiaries inherit IRAs and Roth IRAs, they inherit the same tax treatment. So when money comes out of traditional IRAs that are inherited, your beneficiary pays taxes on them. When your beneficiary inherits a Roth IRA, the distributions come out tax-free. So that's getting a little bit into estate planning, but it all goes back to how long and how do I invest? Will this conversion make sense by growing more than the amount it costs me to do the conversion? Really good questions.
So this might be touching on a really similar, just like similar to your answer to the last question, but someone said, okay, so I just want to make sure I get this right. So if someone didn't work at all for 2 years for some reason, would they be able to convert to a Roth and pay no taxes?
No, because there's not a 0% income tax bracket. There's a 0% capital gains bracket, but there's a, you know what? No, that's not true. If you had no income, you could convert the amount up to the amount of your standard deduction, right? So if this is where like a CPA only, now I can't remember how much a standard deduction is. Is it $12,000? I don't think that's right, but let's say it was $12,000. You could have income of $12,000 from your conversion, offset it with a $12,000 standard deduction, and have taxable income of 0. So again, this is where it's good to get advice on this, right? Like just to see how it all, again, what money is coming in to fill in those income boxes on your 1040. What deductions do you get? Most people now just use the standard deduction. And then what's left over that you're taxed on? That's a great question.
Okay, so another question is, so my employer's 403B, unfortunately, is a traditional IRA. Is it possible to convert that to a Roth later on?
You can, yes. So really kind of throughout your life, every year, you could think about whether or not it makes sense to convert traditional money to a Roth. If you have a 401k, what it looks like for most people, kind of the flow chart is my employer and I contribute to a 401k, a traditional 401k. I leave my employer and I decide, when you leave your employer, you have three choices. You can leave your 401k where it is and it continues to be invested the way you want it to be invested. You just can't put more money into it. You can leave your money with your old 401k. You can move your money into a new 401k with your new employer if it's offered, or most people choose to put it into a rollover IRA. So you could take your 401k, leave your employer, move it into a rollover IRA. Nothing taxable has happened yet. And then with that rollover IRA, you have a low income year and you say, okay, I want to make a conversion this year. You would open a new Roth IRA and move over X number of dollars from the rollover IRA into the Roth. So you'll always, at least now the tax rules have changed, that this is now a strategy that's always available in whatever amount. Like you wouldn't do a conversion, you probably wouldn't convert $1 million in 1 year, because that would push you, that $1 million goes in your taxable income bucket. All of a sudden you're in the $1 million tax bracket, right? But these little chunks over time is something to at least look at or consider every year. Really good question.
So we have two more questions on conversions. Someone said, I've heard of something called a backdoor Roth. Can you touch on what that means generally and if it would make sense to do that?
Yeah, a backdoor Roth is, it's a little bit difficult to imagine, but I'm just going to describe it anyway. So with a traditional IRA, there's a very low, not very low, there's a relatively low income threshold for being able to put money into a traditional IRA and get a tax deduction. So starting at something like $65,000 if you're married filing jointly, you might not be able to get a pre-tax contribution into a traditional IRA. But there's no income limits for being able to make a post-tax contribution to a traditional IRA. So a backdoor Roth IRA is typically used for once you're kind of in a higher tax bracket, a higher income situation. What you do is you open a traditional IRA, or you have a traditional IRA. You make a $6,000 contribution, but you don't get a tax break for doing it. You put $6,000 in, and it is basically the same as putting $6,000 into a Roth IRA, because you don't get a tax break putting money into the Roth IRA either, right? Because that's post-tax money. So you put post-tax money into your traditional IRA. Then you file the form that says, okay, I would like to convert my traditional IRA into a Roth IRA. Since you have already paid taxes on this money, you don't owe more taxes when it comes out because you already paid taxes on it, and you get to put it into your Roth IRA. Whereas you couldn't put it directly into your Roth because you're over the income limits. This makes the most sense for people who do not have in their names, they don't also have a rollover IRA, a SEP IRA, another traditional IRA, or any other non-Roth IRA, because the rule is when you're making a conversion, there's trying to like find some sort of visual here. In your traditional IRA, the IRS is keeping track of what portion in your traditional IRAs have already been taxed and which have not been taxed. The assumption is that in your traditional IRAs, almost all, if not all of that money has not been taxed yet, so you owe taxes on it when it comes out of the traditional IRA. If you have a large, let's say you have a $100,000 traditional IRA, and you want to do a backdoor Roth, you might make a $6,000 contribution into your traditional IRA. The IRS says you don't get to cherry pick and say that, hey, this $6,000 chunk has already been taxed. That's the chunk that I want to take tax-free and move over into my Roth. Instead, the way the IRS will look at it is that basically 6% of your IRA can be moved over with no taxes owed, but the other 94% you owe taxes on. Don't know. That's going to be really difficult to make sense kind of verbally. Did that make sense? Did that answer the question of the person that asked it, or did it just make things worse?
So if you had the question on the backdoor Roth IRA and you have like a follow-up question, you can type that into the chat box and I'll make sure that we address it maybe once we get through the slides. But so I lied, there are two other questions for this. One of them is a clarification from the previous question. So when rolling over from a traditional IRA into a Roth IRA, the maximum annual contribution for the Roth IRA doesn't apply.
Yes, that is a really, really good question. A conversion is not a contribution. So now we're kind of getting into being specific about what we're talking about because it makes a difference to the IRS. A contribution is money you're taking out of your earnings and putting into a retirement account. A conversion is taking money out of one retirement account and moving it to another retirement account, taking it out of a traditional and putting it into a Roth. A conversion is not a contribution. So you could make a $6,000 contribution for 2020 and a $10,000 conversion in 2020. Those are two different transactions. That's a really good question. And neither of those are a rollover. That's a third type of transaction. So the rollover from the 401k into the rollover IRA is a rollover. Your new Roth IRA that you put money into from your earnings is a contribution. And then the conversion from your rollover IRA to your Roth is a conversion. So this is really, this is kind of where I'm trying to be specific because the IRS is specific, but it also is important for you to kind of get a handle on so that you know what types of transactions are available to you and kind of what your impact is. So again, like at the bottom, it's a good idea to get advice on this. Just know those things, those parts of it, like the little nuances, just so you don't get hit with an unexpected tax bill. Like you kind of did something wrong.
Okay, so last question on conversions. Kind of keeping in mind that, it's good to get advice on this from different people and different financial experts, including like a CPA. If someone is 99% sure that they will make less money in retirement than they are now, does it make sense to even convert any of a traditional to a Roth?
I would say maybe, depending on how large your traditional IRA is or your traditional accounts are, you would want to take a look. If you have a giant traditional retirement balance, you will want to look at what your required minimum distributions will be once you turn 72, to make sure that once the IRS starts making you take the money out, you don't want those required minimum distributions to bounce you up into a higher tax bracket than you otherwise would need to be in. So I would say if there is this case where you have a large traditional retirement account, but small, relatively small lifestyle needs, right? So this is like millionaire next door type of stuff, right? Like, I don't spend very much money, but I have all this money. Like, you'll want to get a schedule of what those RMDs might look like in your 70s, so you don't take out, you have to take out this big amount from a big IRA, and it would push you into a higher tax bracket. So then it might make sense to look at conversions. Really good questions. Oh, I have 6 minutes left, and I think I only have a couple more slides. So I'm going to get to it. And then I know we're getting close to the end, and we probably won't have a ton of time for follow-up questions. But I do, on my last slide, have my email address so that, you know, whether you have an idea for a topic for a future month, or if you have, you know, some other educational question that we can help answer, then you'll have a resource to do that. Oh yeah, all right. Optimization number 5, use stock market volatility to your advantage. I know that most of the time we think about stock market volatility as a drawback, as some of the things to avoid when we're investing. But if you have a long enough time horizon, you can flip the script on that and look to it to be an advantage, to be a feature instead of a drawback. Risk can work in your favor. I mean, this is definitely something that I think of as an optimization, not where most people start out thinking about risk and the stock market especially. But if we look at the stock market over the long term, this is the type of chart that we see. This, the darker line, the dark green line, is the Dow Jones Industrial Average going back to the beginning of 2007. And the blue line is just a broad US bond market exchange traded fund, ticker symbol AGG. And so what we see here, what I'm trying to show you here, is the difference over a long enough period of time, this is 13 years, between investing in stocks, which is by its very nature volatile, and bonds, which by their very nature are more stable. The reason that you choose stocks over bonds is because over time you expect to get a higher rate of return and you expect to end up with more money. So this is where you are opting into taking more risk, and you're not trying to avoid it. You are accepting that you are taking more risk in the short term, seeing prices bounce by a lot in the short term, because you would like to be a part of this general trend of the green line. So going back to the original question of, does that 10% number account for the dips? Yeah, it does. In this case, the rate of return over this period of time is not 10% per year. This green line, so over 13 years from 2007 to 2020, over those 13 years, the stock market doubled, right? So it's up over 105% over those 13 years. That's not a 10% rate of return, but it's, I'm trying to do the math in my head, but I'm not going to do the math. It's 5-6% per year. So not at that 10% per year, but the bond market, the safer bet, is much lower than the stock market has been. So when we're choosing investments, you're trying to choose relative performance. If you stick on the safer side of investing, you will almost certainly over long periods of time end up with less money. it's much more stable, right? So that, that might appeal to you more than having the higher account balance. Is okay, I have more stability, that's what I value more. But the stock market goes up and down forever and for all times. We have two crashes here, right? We have that one, we have the financial crisis crash. You can kind of see that downturn in 2016 that I was talking about. You can see the downturn at the end of 2018, and you can see the super big downturn from March. Those can be viewed, if you have a long enough time horizon, as buying opportunities, because the idea is to buy low and sell high. If you have enough time to let the stock market work out its thing, and the companies that are in the stock market, you give them enough time to figure out how to make profits in whatever economic environment we have, then taking that extra risk in the stock market should work to your advantage, and you should end up with more money. This kind of harkens back to the stock market topics that I've led in the past, where it comes down to, in the US, companies are incentivized to create goods and services that people buy. They're incentivized to make profits. And those profits are reflected in the price of the stock market. That's what the stock market is. So if you assume that companies in the US are going to create the goods and services that we buy, and then they're going to solve the problems that we have today and the problems that we will have in the future that we haven't even thought of yet, then the stock market is your way to participate in that. And by taking that extra risk in the short term that you have to get through March 2020 and whatever happens in the future, you expect to be compensated with a higher rate of return over time. And it might not be 10%, it might be 9%, it might be 6%, but it will be higher than the low risk alternative. That's the main point. It'll be higher than the low risk alternative. You can take little to no risk and get 0% or 1% or 2%. Is that enough? If you're super wealthy, that might be enough. But if you're not, you probably need to take risk to get closer to the green line than to the blue line. And here's just a chart I like to show that shows all of the different crises that we've been through since 1957 and the way the stock market reacted to all of them. There will never, ever, 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 ever be a time where investors say, we have nothing to worry about, everything's fine. Ever since I've been teaching this class, leading this group, and doing everything with my business, there has never been a time where investors were like, I don't really have anything to worry about. I think we've got everything pretty much solved. Like, there's always something to worry about. And the stock market, like, it knows that, right? So the stock market doesn't ever assume that everything's fine. It gets through crises, really no matter what they are. The flexibility is built into the system. But it does mean that as a person, that you do have to get through these terrifying drops. And that's not for everyone. I 100% concede that. It's not for everyone. But you can, again, flip the script and start thinking of it as a feature of investing in the stock market. Oh, hey, I might get a chance to invest some money when the stock market crashes. And then I'll just wait 30 years for it to grow, and then I'll end up with more money. If you can do that. It's just a change in perspective of why you are investing. That's all I have for today. Thank you, everyone, for all of your questions. They were really, really good, insightful questions. And I know this was kind of quick on a complicated topic, but I think we got a chance to hit on a lot of good themes. If you have any questions, here's my email address, so please email me. Otherwise, we'll see you on July 11th. I think we are going to post the recording. I think we're going to try to post the chat. So I'm assuming there are some discussions and questions that are going on in the chat that might be valuable for you to look back at as we go forward. And we're definitely looking for people who can maybe host some topics. If you have a financial topic that you're passionate about or that you want to learn more about or that you'd like to talk about, a lot of our topics are led by our members, right? So last month, Lori led a discussion on investing for beginners, and she led it from the perspective of someone who's been a beginner before and someone who has a little bit more experience now but isn't a professional. How would you explain to a friend of yours how to start investing? We've had other members, Caitlin, I don't know if you're on the call, who have led topics on talking to your kids about investing and money. Like those are all things you don't need to be a professional to talk about. So if you are willing to kind of get on the Zoom call and lead one of these, we would really, really appreciate it. We always love hearing things from a DIY investor's perspective, and it's really helpful for the other people in the group. Gwen, thank you so much. Is there anything else we need to cover before we sign off?
There's one question that I want to make sure we get answered, because there were a couple of people that seconded that they had the same question. So with some of these sort of complicated questions about tax strategy or conversions or backdoor Roths, Sara, would you know what kind of professional is best, we could best like point those questions towards?
Yeah, I mean, I think as soon as you start talking about tax strategy, my personal opinion is that's when you start looping in a tax professional and paying someone to be available to answer these questions for you. Usually it's just worth the money, and there's CPAs or enrolled agents, or even if it's like the subscription on TurboTax where you get access to a professional. When you start talking about conversions, that to me it's beyond the basics of filing your own tax return, right? Like you're starting to get into the strategy aspect of it, and I think you need to start looping in a professional. So that's what I would suggest is, can you find a person that you can ask these questions to? And it really is a tax person. I mean, as an investments person, I am registered and licensed to give investment advice. I am specifically not registered and licensed to give tax advice, right? So for my clients, I can run through the numbers and kind of show them what I think would be advantageous. But ultimately, the advice, it should be run through your tax person who really has a handle on what your specific situation is. I'm a big believer in paying for tax advice. I think because I found it to be incredibly valuable, especially over the last, 5-ish years, right? Like the decisions start being important. If you have a really, really simple tax situation where you're a W-2 employee and you just have to fill in your W-2 numbers, then definitely keep using TurboTax or doing it on your own. But once you start thinking about these different strategies, and especially once the numbers start getting bigger, it makes sense to loop in a person. Anything else, Gwen?
That was it. There may have been a couple of questions that I might have missed, mostly because there was some great discussion in the chat box.
Awesome.
So that was really great to see. But if your question was missed today, if we didn't get to it, please feel free to reach out to Sara. And this is also for people who aren't seeing the chat box. Maybe you didn't have access to the chat box today. You can email Sara your questions at sara@blackbarnfinancial.com. And we'll try to get an answer to you pretty quickly.
Oh, thank you again for everyone whose faces I can see on the video and everyone who participated. I think we're kind of getting the hang of doing this virtually. So it makes me so happy to know about all the discussions that were taking place. It's what makes this group so special. Thank you, everyone. It just fills my heart with joy to see all of you on the call. And can't wait to see you all in person again one day.